One thing that is really connected to that, on which we also want to talk about today, is fire and retire on Bitcoin. So fire meaning the financial independence, retire early, if I got that right, and basically the retirement on Bitcoin topic, because it ties into personal finance a lot. For the people that aren't aware of fire, what is fire and what is the fire community all about?
Yeah, you got it right. It stands for Financial Independence, Retire Early. It's a movement that was kind of started in, I don't know, maybe 10, 15 years ago. One of the key influential figures is a guy by the name of Mr. Money Mustache. And he had this blog talking about how you can basically save money very actively, very proactively, be very intentional about the money that you are spending and making sure that you're living somewhat frugally and not wasting money on stupid stuff that doesn't actually add value to your life. And then taking whatever excess savings that you have and investing that as quickly as possible, as much as possible. And primarily the vehicle that is used by the fire community traditionally is the stock market index, the total stock market index. You're not necessarily picking stocks and trying to pick winners and losers. You're just buying all of the companies that are based in the US. And the US market is a very important aspect of this because the US has historically outperformed the international stock markets because the US has the tailwinds of being the global leader from an economic perspective and really came off of the industrialization that happened going into the 1900 and through the First World War. That was kind of built off of the gold standard, in my mind, right? It's that you have these incentives in place that encourages savings. You have free markets, and that led to this massive increase in capital and a spirit of entrepreneurship and inventiveness that created the world that we're still enjoying today, right? Like all of the seeds of the big inventions and the massive amount of progress that has been made over the last 150 years were those seeds were planted in the late 1800s when we were kind of on the classical gold standard, and this incentive structure of saving and investment and capital accumulation was really taking hold. We've gone away from that, but a lot of the momentum that was created from those seeds being planted are still being sown, right? Like we're still benefiting from the fact that we created this environment where the US would be the global leader. And the financial system has morphed in a lot of different ways. We're no longer on a gold standard. That ended in 1971 when Nixon closed the gold window. And since then, we've been in a credit-based economy where you're continually needing to expand the amount of credit that is in the economy, and that credit acts as money at this point in time. U.S. Treasuries sit at the foundation of the financial system, and credit, like bank deposits, act as the payment mechanism that we all use. And that's what drives prices, is this increase in credit that has to happen because this is all debt based. And if you don't increase the credit, then you end up with this downward pressure of deflation as the debts come due, but there's no new money to actually service both the debt and the interest that is attached to that debt. What that means is that the fire community has tapped into kind of a truism of the way that the financial system works and the way that the markets work, which is that the stock market is always going to go up, and it's always going to go up because you've got productive companies that are accumulating capital, but they're also benefiting from this tailwind. And in reality, they're mostly benefiting from this tailwind of an increase in the money supply, that into that bank deposit money that is out there that is feeding into their bottom lines and causing the valuations to grow in dollar terms, regardless of the fact that they may not be profitable. They may be fueling a lot of that growth on debt and this expansion of credit that's happening. So bringing it back around, you have a stock market index that you can buy, which gives you exposure to the entire US stock market. And historically speaking, it's risen at a value of anywhere from, call it 8 to 10% nominally per year over the last over 100 years. And that just so happens to kind of eke out a little bit of a real return relative to the expansion of the money supply, which is somewhere in the neighborhood of 7% per year. And so if you are aggressively saving, if you are plowing the savings into the stock market index, you are enjoying an increase in wealth relative to your costs that are also increasing, but you're kind of outpacing it in very slim margins. And that allows you to become wealthy and to get to a point where you no longer have to work because you can start to live off of the returns that you're generating in your portfolio. So the approach that the FIRE people take is intentional spending, live like somewhat frugally, and take any excess savings that you have and plow it into the stock market index and build up a portfolio that is large enough to support the expenses that you have on an annual basis. And based off of the historic returns that the US stock market has generated, you can do that with about a portfolio that's about the size of 25 times your annual expenses. And the inverse of that is called the 4% rule. In other words, you could live off of 4% of the value of your portfolio on an annual basis by selling down that portfolio. And at the end of a 30-year period, you actually are more likely than not to end up with a larger nominal portfolio value than what you started with. So you can reach this early retirement, live off your portfolio, and go do whatever you want to do, right? You can quit your job, you can go work on a passion project, you can travel the world. It's totally up to you. But the important point is that you've reached financial independence. You're no longer tied to a particular paycheck, and you can live off this nest egg that you've built in the form of a savings portfolio.
Super interesting. Except that the FIRE community is still very feared, just from the fundamentals or from the principles that they teach. It's very Bitcoiny. For lack of a better word, Bitcoiny, but like live within your means, be frugal, stack consistently. If you have stacked enough, you can live your life and you can take a small portion of your stack and live from that and be independent and use your Bitcoin. So those are all concepts and principles that are really popular actually in Bitcoin. Now, the interesting question is, how does the FIRE change when you mix in Bitcoin?
Yeah, so you're hitting on exactly right. There's this overlap in the approach that the FIRE community has that Bitcoiners kind of naturally have because they're starting to denominate their lifestyle, or they're starting to use Bitcoin as their unit of account and recognizing the opportunity cost that you have for every dollar that you're spending that you're not saving in Bitcoin, which is growing at a much faster rate than the stock market is. So my newsletter is called Fire BTC. Every week I write about how Bitcoiners can achieve financial independence and how FIRE practitioners can incorporate Bitcoin into their plan. And it was based off of this post that I published back in, I think it was March of 2023, called Bitcoin is FIRE Friendly. And Bitcoin is FIRE Friendly was really built around the dynamic that you're talking about, which is that FIRE practitioners actually, they intuitively understand a few core truths. One is that the financial system is not really what it seems, that it's actually built on credit and not based on money, that life continually gets more expensive. And then in order to combat that, you need to invest. You can't just save money, right? So these are all things that the FIRE community intuitively understands, and they choose to use the stock market index as their preferred vehicle for outpacing that increase in living cost, and then achieving financial independence earlier in life than the traditional retirement age of 65. When you incorporate Bitcoin into your FIRE plan, you now have a path for accelerating that early retirement or achieving financial independence in a much you're accelerating it to a point where you can actually reach that financial independence much earlier in your life, because Bitcoin is growing at a much faster rate. But it requires that you actually understand what Bitcoin is and what the utility is, and it requires that you understand how to deal with volatility and all of this. What Bitcoiners do is recognize that Bitcoin is the apex predator of store of value assets, and that by incorporating it into a FIRE plan does give you this path for accelerating financial independence. So if you can recognize this, and if you can find the proper balance of having a stock portfolio and a little bit of Bitcoin, at least as you're getting started, you can actually start to get to that financial independence and that early retirement in a much quicker way. It also, if you kind of, the more you allocate, the because of Bitcoin's historic growth rate, and because it might continue to grow at that faster rate, it actually allows for you to live off of maybe a smaller starting value. This is kind of the other side of accelerating this financial independence journey, is that you actually could save up a little bit less before you can reach that goal, as opposed to saving up the same amount as what you would be targeting for a stock portfolio, but then just having that grow to an extraordinary amount of money by the time that you were to pass it on to your family members.
That's super interesting. Also that 4% rule, just so that I got it right, 4% means you can use 4% of your complete stack and basically live off that from an annual expense. So the FIRE target in that case would be you need take your annual expense. Let's say it's 40,000 a year. Then you would need $1 million in a stack to actually be able to stack. It's an interesting rule because it's also kind of conservative. I don't know if you've mentioned, but I've heard that you said like you can pump the number of 4% to 8% when you use Bitcoin. That comes from you, right?
Yeah. So in a recent issue of the newsletter, I explored in more of a qualitative way as opposed to a quantitative way as to like, what does it mean for Bitcoin's growth rate to be so much higher than stocks if you're incorporating that as a large percentage of your portfolio? And just being very conservative, Bitcoin has historically grown at 50 to 60% per year. It remains to be seen as to how quickly it will grow going forward and what that curve is going to look like. But if we're very conservative and just say, instead of Bitcoin growing at 7% like it does in the stock market, it grows double 7%. Well, that does imply that you could actually withdraw double the amount for the same portfolio value. So instead of having 4% rule, you could actually have an 8% rule. Now, the biggest risk to this is Bitcoin's volatility. So there's something called sequence of withdrawal risk. And if we put Bitcoin aside and we just think about the stock market, if you were to reach your financial independence number in September of 2007, and then by April of 2008, you have retired and you're starting to draw down 4% on your portfolio, the stock market got cut in half over that next year, right? What that means is that you are now withdrawing a 4% of your original valuation, which, let's call it $1 million for each 40,000 that you are spending. Well, if that $1 million very quickly drops to being a portfolio only worth $500,000, all of a sudden your early retirement is in jeopardy because you're selling down these assets at much lower valuation, and thereby you're actually living on maybe an 8% withdrawal rate. Well, it might take a long time for the stock market to recover and get you back to your original valuation. And when you look at the historic data, that sequence of withdrawal risk is really the one big issue with retiring early and living off the 4% rule if you are starting exactly along those guidelines. And so if you can get past the first couple of years without that big drawdown, there's pretty much no instances in the historical record where you would run out of money after a 30-year period. But there is that risk of the first, call it year or two, where if the market draws down drastically and you've already retired and you're drawing down on a larger portion of the portfolio than you were expecting, it can put that retirement at risk. Bitcoin has the same problem or the same issue or the same risk available to it. It's just that the volatility is at a much larger amplitude there. And so you still need, even if you are withdrawing at an 8% rate, you still need to take that into account and have a plan for if the Bitcoin price withdraws by 80% in the next year, that after you've retired, that you have some way of maybe supplementing your income or reducing your expenses so that you can weather those first year or two. The reality of the situation is that most people's this is all very plannable. Like, you can plan for this type of volatility. You can put some plans in place that allows you to be flexible on the income that you're producing that can supplement these types of years, or plan to go live in a country that has a much lower cost of living for a year while you weather the storm. It's a kind of a perfect opportunity to see the world and accomplish this other goal of making sure that your retirement can last. But if you're just going strictly with the 4% rule or the 8% rule when it comes to Bitcoin, you do need to be cognizant of this risk, which is that if the price draws down very drastically in the first year or two of your retirement, it might be put at risk. You just got to have a contingency plan in place.
There's also one aspect that I always like to bring up. I couldn't sit around and do nothing, even if I had financial independence, and I don't. But if I had that, I would still do probably what I currently do with the podcast because it's just so fun. Maybe I would do it less professional and don't care about thumbnails.
Yeah, most people are like that, right? They've got some type of passion that they would like to pursue if it weren't for this pesky job that takes up, 8 to 10 hours of their day, right? And so, and especially today, there are so many different ways that you can bring in an income that doesn't require you to be going into an office and sitting in a cubicle and working like a traditional job to cover at least some portion of the expenses that you've got. And in doing so, it makes the portfolio that you've got that is covering the rest of your expenses that much more conservative. So there's a lot of different flexibility that you can put into your particular plan. And ultimately, it is a personal decision as to how you approach this. That's the way that I talk about this, right? Is that, there's some guidelines that we can put in place, the 4% rule or the 8% rule if you're incorporating Bitcoin. But ultimately, you've got to figure out what works best for you, and based off of the opportunities that you've got and the expenses that you want to have, and in the retirement that you want to create for yourself, is all going to affect how you think about the amount that you need to save and what your asset allocation is going to be, and how you're going to manage all those different aspects.
So the rule basically would be, do you have enough Bitcoin to support 1 year of expenses with 8% of your stack? And are we currently in a bear market? So if you're currently in a bear market, you can still do it. It might actually work out. If you're currently at the bull market, let's say we rally end of the year to 250,000, and then you reach that point, it might be a risky point because maybe we crash down to 120K again, and all of a sudden your calculations are not working anymore.
Yeah, there's a number of different ways that you can kind of adjust the math to make it more conservative, right? You could think of it in terms of, okay, instead of an 8% withdrawal rate, I'm going to just target a 6% withdrawal rate, which means that I've got to save up a little bit more, or the price of Bitcoin has to go up a little bit more before I can retire. But that's going to make it more conservative, which allows you to not be as exposed to that first year or two of a price drawdown if that were to occur. You could also think about valuing the Bitcoin that you own at something other than the market price. So if you look at the 200-week moving average, it's sitting somewhere in the neighborhood of like 44,000 or 45,000 right now. So if you ignore the current market price and say, okay, I've got this Bitcoin stack over here, and I'm just going to, instead of applying a market valuation to it, I'm going to apply a 200-week moving average valuation to it. Well, now all of a sudden, you've got probably a lot further to go in order to actually reach that fire number, but you're massively reducing the chances that you're going to end up in a more risky situation when it comes to this sequence of withdrawals that you're having to deal with.